The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltales Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. And before we get into it, happy Mother's Day to all the moms in the audience. Thank you for spending part of today with us. Here's the throughline for this week. AI is finally paying, but the unit economics of how suppliers capture that demand vary wildly. On Wednesday's show, Hunt, Jason, and Mike walked the hyperscaler stack from the bottom up. Hunt made the case that Amazon's networking edge may matter more than NVIDIA's chips. That was the architecture conversation. Today is the unit economics conversation, supplier side. Micron printed the cleanest version. Customers writing prepayment checks for memory that doesn't exist yet. Pricing power so strong it's hitting cash this quarter. AMD printed the messier version. Data center revenue up 57%, but the strength was in EPYC processors, not the OpenAI deal everyone is anchoring on. That deal, signed last October, OpenAI got warrants for up to 10% of AMD, contributed $0 to Q1. Shipments don't start until the second half of this year. The CPU side of AMD's print connects back to Intel 2 weeks ago. Same demand signal, different name on the box. That's the show. 2 supplier prints this week, both validating AI demand. Very different evidence about pricing power. Micron is charging customers in advance. AMD's strength came from CPUs, not GPUs. Same story Intel told the market 2 weeks ago. Page 8. Micron. Micron's 2026 high-bandwidth memory is fully booked, with customers signing multi-year prepayment agreements for supply that doesn't exist yet. CEO Sanjay Mehrotra said Micron can only meet between 50 and 67% of demand from key customers. The 4 largest spenders on AI, Meta, Microsoft, Amazon, and Apple, all publicly cited memory cost and availability constraints. Stock hit an all-time high of $683 on May 7th. Mizuho took the price target from $545 to $740, and Micron raised fiscal 2026 capex to $25 billion from $20, a 25% step up. And AMD, after the close on May 5th, Q1 revenue $10.3 billion, data center revenue up 57% to $5.8 billion, Q2 guidance $11.2 billion, stock up 16% the next day. Important read on that data center number. The growth came from EPYC server CPUs and the existing Instinct GPU ramp, not from the OpenAI deal. Per the 10Q, the OpenAI warrants haven't vested. Shipments don't start until the second half of this year. The deal contributed $0 to Q1, which connects directly to Intel 2 weeks ago. Intel printed Q1 revenue up 7% year-over-year to $13.6 billion, with management telling the street that the CPU to GPU ratio in AI deployments is shifting from 1 to 8 toward 1 to 4, and trending toward parity as multi-agent workloads scale. That's the read across both prints. AI demand isn't just GPUs. Hyperscalers are buying head node CPUs alongside their accelerator clusters. CPU demand is having a renaissance after 2 flat years, and AMD just confirmed what Intel told the market. Marcus, the cash flow take.
The Q1 print is good news about the business AMD already has. EPYC share, current Instinct shipments, not about the business AMD bought with equity last October. The OpenAI warrant is a future customer acquisition cost that doesn't hit the P&L until the second half of this year. When it does, it shows up in 2 places, as data center revenue ramping into 2027, and as up to $160 million shares of dilution if MI450 hits its deployment milestones. The memo had AMD at 167 times trailing free cash flow on $4.4 billion of TTM FCF. That multiple is being defended by the forward book, not by what just printed. Q1 didn't move the actual question. The actual question is whether the OpenAI relationship, paid for in October at a penny a share, produces enough revenue to justify the dilution. We don't get a read on that until late 2026 at the earliest. The compare to Micron sharpens the point. Both names trade at multiples that need a story. Micron at 209 times free cash flow has the leverage of a structural shortage. They're charging in advance because they can, and the cash is hitting the bank this quarter. AMD at 167 paid customers in equity last October to lock in revenue that hasn't started yet, while the current quarter prints fine on CPU demand and legacy GPU shipments. Both stocks are pricing forward stories. Only one of those stories has cash hitting the bank right now.
Two suppliers, two prints, same end market. Pick your fighter. Page 17, Palantir. The cleanest AI is actually paying print of the cycle so far. After the close on May 4th, Q1 revenue $1.63 billion, up 85% year over year, the fastest growth rate since the company went public in 2020, beat consensus by $90 million. U.S. revenue alone hit $1.28 billion, up 104%. The first time U.S. growth has crossed 100%. U.S. commercial revenue up 133%. Net income quadrupled to $870 million, EPS 34 cents. Adjusted free cash flow $925 million on a 57% margin. Rule of 40 score 145. Quick aside for listeners who don't follow software. Rule of 40 is the standard efficiency benchmark in SaaS. You add a company's revenue growth and its profit margin. 40 is the bar for a healthy software company. Palantir is at 145, roughly 4 times the bar. Back to the print. Full year guidance raised from $7.2 billion to $7.65. Marcus, the cash flow take.
Palantir is the proof point that the rest of enterprise software has been promising and not delivering. The memo has Palantir at 160 times trailing free cash flow on $1.9 billion of TTM FCF. We re-anchor when the Q1 10Q files. The number that actually matters from this print is the U.S. commercial line. That's a customer set that didn't exist 18 months ago, paying real money for AI deployment, not pilots.
160 times free cash flow. Rule of 40 at 145.
160 times is not defensible on a static comp. It's defensible only if you believe the U.S. commercial growth rate doesn't normalize for another 4 to 6 quarters. So wait the outcomes. Bull case at 30%. Government and commercial both compound from here. Base case at 50. Commercial decelerates and the multiple compresses by half on a stock that still works. Bear case at 20. The multiple does what 160 times multiples always do.
So the question is whether the customer set that just appeared keeps appearing.
That's the entire question. Argus upgraded to buy on May 7th. Citi took the target to 225. The street is pricing the bull. Watch the Q2 print for whether U.S. commercial holds north of 100% year over year or steps down to 70. 70 is still a great number. It is also a different multiple.
145 rule of 40. That number alone is the whole story. 5 to close out. 1 preprint catalyst, 3 prints already on the tape, and the forward week. First, Circle. Reports Monday morning, Wall Street consensus $717 million revenue, 18 cents EPS. The setup matters more than the number. The Clarity Act compromise cleared Congress, banning passive deposit-style yield on stablecoins while explicitly preserving rewards tied to user activity. The stock jumped 20% on May 4th. USDC circulation hit $78 billion. Visa is rolling out USDC settlement to U.S. banks, including Cross River and Lead, and signed on as lead design partner for Circle's ARC blockchain. MasterCard expanded USDC settlement across Eastern Europe, Middle East, and Africa. Wall Street's consensus on Circle, a crypto play with regulatory tail risk. After this week, that's not what Circle is anymore. Stablecoins just became payments infrastructure. Watch the reserve income line on Monday. Second, Disney. Tomorrow's first full quarter as CEO and the integration thesis printed. Reported Tuesday, May 6th. Q2 fiscal 26 revenue $25.2 billion, up 7% year over year. Beat consensus. Streaming income up 88% to $582 million. Parks operating income at a fiscal Q2 record of $2.6 billion, despite domestic attendance down 1%, per capita spending up 5%. ESPN direct-to-consumer launched at $29.99 a month for unlimited, and Disney raised the fiscal 2026 buyback from $7 billion to at least $8 billion. Memo had Disney at 21 times trailing free cash flow on $10.5 billion of TTM FCF, a 5.6% yield. Streaming is a profit line now, not a loss line. Third, Uber reported May 6th, Q1 EPS 72 cents, beating consensus of 70. Revenue $13.2 billion, slight miss. The numbers that mattered weren't in the headline. Uber One membership crossed 50 million, and members now drive 50% of gross bookings across mobility and delivery. Adjusted EBITDA crossed 33 press increments in Talentfit. Now it is still less than $1.5 billion. Adjusted EBITDA crossed 33% year over year. Buyback authorization raised by $20 billion. Last 12 months free cash flow at an all-time high of $8.5 billion. The Cash Flow Memo had Uber at 11 times trailing free cash flow on $13 billion of TTM FCF, the cheapest AI distribution play in the universe. The autonomous threat became the autonomous distribution contract. Fourth, Airbnb reported May 7th, Q1 revenue $2.68 billion, beat. EPS 26 cents, missed by 3. Gross booking value up 19% year over year to $29 billion. Adjusted EBITDA up 24%. The numbers from the call that matter for the throughline. Nearly 60% of Airbnb engineering code in Q1 was co-authored with AI, roughly double the industry average. Their AI customer support agent now resolves 40% of issues without human escalation, up from 33% earlier in the year. CEO Brian Chesky said AI-enabled engineers can now do work that previously required teams of 20. Memo had Airbnb at 23 times trailing free cash flow on $3.2 billion of TTM FCF. Summer release lands May 20th. Chesky is running the most visible AI-native operations reorg in consumer tech. And fifth, the forward earnings sweep next week. Venture Global reports Tuesday. Home Depot Tuesday, Walmart, Target, Lowe's, Deere, and, the one to watch, NVIDIA, all in 72 hours, Tuesday through Thursday. We'll cover NVIDIA properly next Saturday, the weekend before the print, with the options implied move and the H200 China question front and center. That's the show. Wall Street's consensus this week: AMD is the cheap NVIDIA alternative, Micron is priced for perfection, and Palantir is hype, 0 out of 3. AMD paid OpenAI 10% of itself last October to lock in a customer that contributed $0 to Q1. The cash flow from that bet doesn't start for another 2 quarters. The Q1 strength was CPU demand, same story Intel told the market 2 weeks ago. Micron getting prepayments for chips that don't exist is not perfection. It's a structural shortage. And Palantir's Rule of 40 at 145 is not hype. It's the cleanest cash conversion of any software name in the cycle. Hunt, Jason, and Mike are back Wednesday on episode 2620. Download the memo at telltales.us. Happy Mother's Day. We'll see you next Saturday. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase, or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.